Hello and welcome back. As we wrap things up in our final module, I'd like to cover something very important to all Forex traders that you don't see mentioned very often. Now, what we want to do first of all is we want to have a look at our typical screen here that we've got set up in our profile. And we're looking around here at the euro dollar, US dollar, and takes time to kind of line things up and let the market travel into the areas where the trading opportunities are the best. This is why you won't see and haven't seen examples every day. Being patient that's part of it. It's a very important part of trading. So keep that in mind. We've covered setting everything up, getting you ready to trade, and then this important final component, I'm going to cover something known as correlation trading or forex correlation. Now let's take a quick look here at monthly. See, we're down on the month here. Now this is a fresh month, so not too much is going on so far. Down in the weekly, down in the daily, obviously. We've got a little bounce there, 4 hour, not too much going on. And up here, sideways actually. So what I want you to do is let's stretch this out this way. Okay, and also go down here and grab this one, and let's grab that chart and stretch it out this way. Now, the next thing I want you to do is to take this chart here and transform it into a 1 hour. And the very next thing that I want you to do is to take the bottom chart and transform it into a US dollar Swiss franc chart. Now you'll notice something very interesting. Do you see it? I know you can tell me exactly what it is. And what it is that we are looking at basically a mirror image. This bottom chart appears to be a reflection of the top chart. What does that mean? Well, that means that the euro dollar, US dollar, and the US dollar Swiss franc have a very high level of correlation. When the euro dollar goes up, the Swiss franc goes down. And that happens in varying degrees, and the amount of correlation, quite naturally, does vary over time based upon volatility and a number of other factors. But as you can see here, if we took this and let's go up to daily on that one, let's go to daily on this one, go to weekly on this one, go to weekly on that one. You see that? In every time frame, basically, it is a mirror reflection. So why is this important, you're asking? Why are you showing this? Okay, we're showing you this because what many people mistake for the safety and risk control of diversification is actually absolutely nothing of the sort. What do I mean by that? Okay, let's say for instance we were at this particular point on the weekly, and we thought, wow, this is really good. What I want to do is I want to use a system that says, hey, I'm going long. And this is, of course, hindsight, so this is just a hypothetical example. Please understand that. So I'm going long. I'm going to go long here. And you have another system which you use that says, hey, listen, I should be going short the US dollar Swiss franc. Okay, so you've got two positions on. You're feeling excited because you're like, well, I've got two trades on. I'm diversified. I've got money in the euro dollar US dollar, and I've got money in the US dollar Swiss franc. So the trades are on. The fact of the matter is you're not really diversified, because going long the euro dollar US dollar is the same as going short. So effectively, you have basically put on two of the same position. Now, don't let that confuse you, because as you can see, going up here, going down here. Now, in this particular case, you would have been in really dandy shape, because quite obviously the market went up. Of course, you didn't know that down here. And quite obviously, the market down here went down, right? So you would have done just fine if you had taken the other type of trade, where say you were going short here and you decided to go long here, thinking that you were diversified. And to some people, diversification means I have on more than one trade using more than one system. But the truth is, what effects is it going to have on your equity? This is basically it. What's going to happen to your equity? This is the core of all of it. And what happens in this case is it is not true mathematical diversification. Now, I'm not going to continue to rave on and on about this. I just want you to understand it's important. And you can do experiments with the different currency pairs here using this same kind of method that we have shown you here, in order to gain some perspective on what's happening. So let's go here to hourly. Let's go here to hourly. Okay. So here's something interesting. We're actually going to place a trade, and we're going to use correlation to help us out, and I'll show you how you can do that. There are ways that you can offset your risk by using correlation that are very, very handy. So here, let's take a look here. Now let's see. Let's say we wanted to go short here. Okay. Now if we go short in the euro dollar US dollar, for whatever reason we choose to go short, we can offset some of that movement by also going short in the US dollar Swiss franc. And let me show you what I mean by that, so you can actually see it as far as changing equity is concerned. So I'm going to look here, look at the trade possibilities, and really, rather than necessarily waiting for a setup, I'm going to get us in a position to dive in so that we can see this in real time. Okay, so the first order is I'm going to sell, and I'm going to sell this particular thing at 1/10 of an entire lot. I'm going to sell the euro dollar US dollar. Okay, and I'll just give you an example of how this can work. So there we go. I've sold that. Now what I'm going to do is I'm going to immediately go down here and I'm going to sell the US dollar Swiss franc. Okay, so I've sold that. All right, now you can see right here what kinds of things are happening, and you can see things change. Now watch this number here, which is the profit, and watch it very closely how it bounces around. Okay, very interesting stuff. Okay, it's starting to move. Now you see that. Now the combination of these two things can be called what's known as a synthetic security. Okay, and synthetic security is it's like a made up security composed of several discrete individual components. Now we know that there is no currency pair known as the euro dollar, US dollar, US dollar, Swiss franc. It wouldn't be a pair, it'd be a quad. So, but that what we actually have trading here. Okay, we actually have basically this price movement here is the price movement of our synthetic security. And excuse me if that seems a little strange to you, but many people will trade, naturally those who are knowledgeable, based upon the movement of this particular synthetic security. And you can see it moving along here, and the whole objective would be either to offset some loss in one direction, and sometimes to just basically have this trade until it moves into a positive area and close out that trade for what's known as a scalp, in fact. So that makes that very interesting. Now you see how that's moving along. See the changes here right down there? And keep in mind that there are a number of different ways to do this. And you say your trading system has dictated that you're going to go short this particular currency pair, euro dollar, US dollar. Another way to do it, rather than looking for the combination of the two to move into positive territory, is you can simply leave your short trade on, and when your short trade down here moves into positive territory, you could have in fact, you could have a simple profit target, and say you wanted to get 20 pips. When it moves into 20 pips positive territory, you could then be in a position to simply grab that 20 pips and use that 20 pips to offset any movement against your original trade. So I hope that makes sense. I know it may be a little bit confusing because this is a concept that not many people, if any, are talking about. Correlation trading is something that you need to know about, and you need to know about the relationships between currency pairs as you're doing your trading, because otherwise what you'll be doing is you'll be doubling up your position when you didn't really care to. Now say again in our example that you're going long in the euro dollar, US dollar, and short in the Swiss franc, then if you're risking, say, your 3% per trade, then you end up effectively risking 6% because you're effectively using two trades which are the same. So as the market moves, as the euro dollar, US dollar goes in one direction, the US dollar, Swiss franc goes in the other direction. I know that's okay. I may be confusing. I don't want to lose anyone here, but let's go back down, and you can see where we're moving here, and we're letting things move along as we want to, And the market hasn't really gone anywhere, has it? It's been relatively quiet. It's been relatively quiet. So when we look for some sizable movement in one direction or the other, and we would have an opportunity to come down and close out our entire position as a profit for a profit here. And as you can see, we're still in negative territory here, so there's nothing that's really going on. Now here's another technique that you can use. You can actually leg into these. You can, you could actually sell at the same point we sold before, the euro dollar US dollar, and then you could allow it to move into a profit. Okay, and when it moves into a profit, then you might want to sell the US dollar Swiss franc, and that will actually help to protect some profit, because if you sold it and this is moving down, then if it goes back up, the US dollar, the euro dollar US dollar is moving against you. So it starts to go up, the US dollar Swiss franc starts to go down, then you have an opportunity to to grab some profit. And even though it's moving against you here, you're still making some money down here, where you can lock in 5, 10, 20, 30, 40, 50 pips or so as things move along. Okay, let's see how this trade develops. I'm going to place this on pause for a moment, and we'll be right back. Okay, we're back, and what can you see that's different? Okay, let's take a look down here at the changes. You see where the pips have moved up here in the euro dollar US dollar, and moved down here, and you can see that our overall equity has gone up rather than down. It's pretty good stuff. So you can adjust things dependent upon the direction you feel the trade's going to go. Or if you're in a scalping mood, like we're going to be right now, we're going to jump in with just a little bit of profit, and we're going to close that order. Now we're going to jump in and we're going to close that order. Done. Okay. Let's see, account history shows last two trades. Okay, and you can see here 24.30 plus and 20.41 minus, for a total of 3.89 to the positive. Now, in using a standard contract, we would see movements that would be greater. In fact, they'd be 10 times as much. So that would be basically a $38, $39 profit quickly taken. That's, again, you take profits that quickly. That's simply a scalp. So just a quick scalping trade, and that's an example of one way to trade using forex correlations.